Since the Bretton Woods Agreement in 1944, the United States dollar has been more than money. It has been the backbone of the global financial system. It's the greenback, the global reserve, the ultimate safe haven. When the world catches a cold, it runs to the dollar. It looks unstoppable. But history has a 100% failure rate for reserve currencies. From the Roman denarius to the British pound, every king eventually falls. Today, the cracks are showing. Sanctions are weaponizing the financial system, debt is at record highs, and de-dollarization is no longer just a buzzword, it's a strategy. So, let's stop the hyperbole and look at the math. What would it actually take to break the US dollar? Most people believe the US dollar is backed by gold. It hasn't been since 1971. So what happened? After World War II, the US dollar was officially tied to gold at a fixed price of $35 per ounce under the Bretton Woods system. Throughout the 1950s and 1960s, the arrangement worked well. The dollar became the anchor of the global financial system, and confidence in its value was strong. But decades of Cold War spending changed the picture. Heavy expenditures on foreign aid and military commitments placed increasing pressure on the U.S. economy. As dollars flowed overseas, America's gold reserves began to shrink, and the dollar grew weaker. Facing mounting economic strain, President Richard Nixon and Treasury Secretary John Connally took a dramatic step. Without warning, they suspended the dollar's convertibility into gold, effectively cutting the dollar loose from gold. This decision became known as the Nixon shock. How shocking was it? Under the Bretton Woods system, 44 allied nations had fixed their exchange rates to the US dollar, and the dollar itself was backed by gold. In 1971, the United Nations had 132 member states, meaning a single US decision sent shockwaves through roughly 1/3 of the world's countries. The impact was immediate. The official gold price was first raised from $35 to $38 per ounce, an effective devaluation of about 8%. Any currency pegged to the dollar instantly lost value as well. Soon after, the price was raised again to $42.22 per ounce. By March 1973, the system of fixed exchange rates collapsed entirely, and the world moved to a floating exchange rate system, the foundation of today's global currency markets. Today, it's backed by something much more fragile: trust. Specifically, the full faith and credit of the US government. Think of the dollar like a social network. It's valuable because everyone else uses it. This is called the network effect. But trust is a two-way street. The weaponization factor. After Russia's February 2022 invasion of Ukraine, the US and allies froze $300 billion of Russia's foreign exchange reserve. Regardless of the politics, this sent a shockwave through the world. Every country, from China to Brazil, suddenly realized, if the US doesn't like what I do, my savings can vanish overnight. The alternative. When trust in the neutrality of the dollar fades, countries begin looking for the exit. We aren't seeing a mass exodus yet, but we are seeing financial insurance policies. Central banks buying gold at the highest rates in 50 years. Another breaking point is the internal rot: inflation. A little inflation is like oil in an engine. Too much is like a fire. If the Federal Reserve cannot maintain the dollar's purchasing power, the store of value function dies. Here is the math of a breakdown. As of early March 2026, the United States is carrying a staggering burden, nearly $38.8 trillion in national debt. According to the Congressional Budget Office, the U.S. government will pay close to $970 billion in interest in 2025 alone. That is, money not spent on infrastructure, healthcare, or national defense, but simply the cost of servicing existing debt. In fact, interest payments already surpassed Medicaid spending in 2023, overtook defense spending in 2024, and are projected to exceed Medicare spending by 2029. CBO projections warn that public debt will keep climbing in the years ahead. If interest rates rise by just half a percentage point, alongside an expanding debt burden, annual interest payments could soar to nearly $2.1 trillion by 2036. Some economists warn of a dangerous cycle, often referred to as a debt death spiral. If interest payments become too large, the government may be forced to borrow even more money, or, in extreme cases, create new money simply to cover the interest on existing debt. The consequences could be severe. When more money floods the system without a corresponding increase in goods and services, more dollars begin chasing the same amount of goods. And when that happens, prices rise, and inflation accelerates. When a citizen realizes their savings will buy 10% less next year, they stop saving. They spend immediately. This velocity of money creates a feedback loop that is incredibly hard to break without a total economic crash. Markets can handle bad news, but they cannot handle uncertainty. The US dollar is the world's cleanest shirt in the dirty laundry. Even with its flaws, it's seen as safer than the euro or the yuan. But that safety relies on stable institutions. What breaks the dollar here? The debt ceiling circus. Every few years, the United States flirts with the possibility of a technical default. But what exactly does that mean? A technical default occurs when the U.S. government fails to meet certain non-payment obligations during political standoffs over the debt ceiling, creating the risk of severe economic disruption, even if the government never actually misses a debt payment. Even the threat alone can rattle financial markets. It can drive up borrowing costs and raise the risk of credit rating downgrades. And the stakes are enormous. If the United States were to miss a payment on a treasury bond, even for a single day, the foundation of global finance could be shaken. The world's so-called risk-free rate would suddenly no longer look risk-free. Institutional decay. If the world perceives that the U.S. legal system or the Federal Reserve has become purely political, the rule of law premium evaporates. If investors start to fear that the rules of the game can change based on who is in the White House, they won't just move to a different currency, they'll move to hard assets like land, gold, and Bitcoin. For decades, the petrodollar was the ultimate insurance policy for the US. If you wanted to buy energy, you had to hold dollars. This created a permanent global buy order for the greenback. But that monopoly is cracking. We are witnessing the birth of the multipolar financial system. It's not just one competitor, it's a coordinated effort to build off-ramps from the US dollar. The power of the BRICS Plus. What started as an acronym is now a massive economic bloc. With the addition of energy giants like Saudi Arabia, the United Arab Emirates, and Iran, the BRICS Plus now controls a massive percentage of the world's oil production and nearly 40% of global GDP. For the first time in 50 years, Saudi Arabia has signaled it is open to trading oil in currencies other than the dollar. If the world's largest oil exporter accepts Chinese yuan, the petrodollar effectively becomes the petro-multipolar. India and the UAE recently completed their first crude oil payment using local currencies, skipping the dollar entirely to settle a multi-million-dollar transaction. Building the digital bypass. It's not just about what currency you use, but how you send it. Currently, most global trades go through SWIFT, a messaging system the US can use to unplug countries it disagrees with. China, Thailand, the United Arab Emirates, and Hong Kong are developing a blockchain-based platform called mBridge. This allows central banks to swap digital currencies directly in seconds without ever touching a US bank or the SWIFT network. It makes the dollar invisible. If a country can trade instantly and securely in yuan or rupees, the dollar isn't broken. It's simply irrelevant to that transaction. This isn't a sudden explosion, it's a death by 1,000 cuts. As China settles more of its massive trade surplus in yuan and Russia moves entirely to friendly currencies, the global supply of dollars begins to pool up. When nations no longer need dollars for trade, they stop buying US Treasury bonds. If they sell those bonds and send the dollars back to the US, it could trigger a massive inflationary spike at home, effectively breaking the domestic economy's purchasing power. This shift means the US can no longer export its inflation to the rest of the world. In a multipolar world, the US government has to live within its means, something it hasn't done in a very long time. So, are we at the end? Not quite. Despite growing challenges, the United States dollar still dominates the global financial system. According to the Federal Reserve, the dollar made up 57.8% of global foreign exchange reserves in 2024. Foreign investors continue to play a major role as well, holding 31.7% of U.S. government debt in 2025. The dollar also powers nearly 47% of international payments worldwide, reinforcing its role at the center of global trade. And even in the fast-growing world of digital assets, the dollar's influence remains clear. Most stablecoins are still pegged to the US dollar. Breaking the dollar is incredibly difficult because there is no viable replacement. The euro has structural issues. The yuan has capital controls. You can't get your money out easily. Gold is hard to transport for billion-dollar trades. To truly break the dollar, you need a perfect storm. You need high inflation and a debt default and a viable global alternative to emerge all at once. It's not a single event, it's a slow-motion erosion. The US dollar isn't going to disappear tomorrow, but its exorbitant privilege is being challenged for the first time in nearly a century. The break happens when the world decides that the cost of using the dollar is higher than the risk of leaving it. The question isn't, when will the dollar fail? The question is, what are you doing to prepare for a world where the dollar is just another currency? Thanks for watching.